Welcome back to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. With me today is Greg Dickerson, who is a real estate investor and developer, coach, mentor, and entrepreneur. Greg, great to have you back on the show.
Hey, Tony, good to see you again.
Greg, we've been talking for months, and you had your thesis about the bottom's not in. We could see, lower lows, and the Fed is still fighting inflation, raising rates. And then we have these black swan events that just happened with FTX. I want to get your take on what's happening with FTX and as well as what we could potentially see with the market.
Yeah. Well, my thesis was the bottom wasn't in even without FTX happening. I think we were going to revisit these levels or obviously test that June low. Potentially it could have held, but my thesis was we were going to break it, go down to that 14, 15,000, hang out and see what happens. Because where we are now from a global macroeconomic cycle, and again, we talked about this last year and Thanksgiving, I was telling my family, get out. This is the top. It's time to get out. They didn't listen. They were still buying. I'm like, this isn't the time to buy. And, and I've taken a little bit of heat along the way. And this has just been a very controlled devaluation and de-risking in the risk-off environment. We went risk-off last year. So that's what's happening right now. And, where we are in the cycle is the markets have priced in the inflation risk. The markets have priced in interest rate risk. What they haven't priced in yet is what a recession looks like, how deep and how long. You can't because we're not there yet. Companies are just now starting to lay off in the tech sector. They were top heavy anyways and bloated. We haven't seen real layoffs in the industries where it matters on Main Street. That's in the housing industry, construction. So you're seeing mortgage layoffs and mortgage companies, are struggling, going out of business because of the interest rates in the real estate market, contracting. You're seeing, all of the ancillary professional services around that, title companies, closing companies, all that kind of stuff. And realtors are starting to feel a little bit of pain. But the construction industry is still finishing, that backlog of houses that they had in production. They're not starting new stuff at scale. So every market's different. There are pockets that are still doing well, but from a national average, builders are pulling back, they're stopping, they're finishing what they have, and they're thinking about their layoffs coming up next year. And then that trickles down from the builders to the subs and their employees and on and on. That's where you're going to get big problems from a recessionary standpoint. So we still have that headwind against us. We still have the war in Ukraine. And then there's always, contagion risks in the crypto market with things that we don't know with what's going on behind the scenes. But, Sam Bankman-Fried and what's happening and Do Kwon and Circle and all of these things are no different than Enron and Bernie Madoff. It's been going on for years in traditional markets. It's just easier in crypto because nobody's watching and nobody understands it from a regulatory standpoint to be able to stop it. So what FTX did is almost not very different than what, Do Kwon was doing.
Yeah. We were talking before the recording, that kind of blew me away because FTX wasn't, in some Asian market, the founder and stuff wasn't hiding somewhere or somewhere in Russia. I don't know. Right. He was meeting with regulators, testifying before Congress, FTX had partnership with Tom Brady, did a Super Bowl ad. They bought a naming rights to the Miami Heat arena. It was on another level. And then, wow, just a collapse.
So was Bernie Madoff. He was on the board of the NASDAQ. He wrote a lot of the, anti-fraud trust rules. And, that's how it works. People with money can buy access and credibility, right? So you just never know what's behind the scenes when the curtain's pulled back. And like Warren Buffett always says, when the tide goes out, who's swimming naked. And, that's what you're finding out here. And it's healthy. You need to clean the bad actors out of the space. And, we're in a risk-off environment. Liquidity is not flowing like it was. You can't get access to free capital. So it's going to clean out a lot of this. What's interesting is how this went down with Binance and CZ. It's almost like he did all this to expose FTX and get them to admit they were insolvent. So it's really interesting, watching these moves and how this is all playing out. And I guarantee you that, Binance is not on the up and up. I guarantee if you pull the layers back there, you're going to see money laundering. You're going to see all kinds of illegal activity. That's why they aren't in this country and aren't allowed to do business in this country. At least, I guess there's a Binance US, but that's a different branch.
Right. Yeah,
Yeah.
they do doing business as Binance, but it's BAM trading services, if I'm not mistaken.
Yeah, yeah. So, and that's why Tether isn't in this country and they won't provide fully audited, legitimate, audited statements and let people look at their books. Cause I mean, there's, same thing. You pull the layers back and you'll see what they've been doing, printing Tether, buying Bitcoin, selling it, laundering money, propping up, Binance, propping up Bitcoin. I mean, that's what's been going on. Now, just the nature of the business. It happens in traditional markets too. We saw the New Jersey deli in your area that, raised all that money and went public, and they weren't even a real business. I don't. Maybe they were selling sandwiches. I don't know.
Right. So, Greg, it's bloody out there. I would love for you to pull up the Bitcoin chart and tell us what you're seeing. And um, do you think Bitcoin could head to 10,000?
Well, right now, 14, 15 is what I've got on my radar. So there's a couple of things here with this, and this all plays in with traditional markets too. It's a risk asset, and it's trading just like the traditional markets and tracking with it. And right now, it's tapping on that 15,000, 16, 15,7, 16,000 level. This is on the daily. If we jump over to the hourly, you can kind of see it just kind of working its way down here. So what I see is a 14 to 15 kind of range, getting down to about 14,000, touching that maybe here in the next day or two. Could happen today. Depends on where this closes at, and kind of tapping on that and ranging maybe in that 14 to 16,000 range. So, the range that we've been in here for the last few weeks, which has been really, let's just go here. So basically, 18 plus change and ranging up to 22. Well, I think that becomes 14 to 16, 17. I think that's kind of what could happen, depending on what's out there, who ends up getting liquidated. This is like if it's just kind of de-risking a little bit and pricing all this action in, that's where it could kind of level out. If it's really bad and things start blowing up, sure, they could go down and hit 10. But I think the likely probabilities, and in trading and in investing, you're talking about probabilities, right? What's likely?
Sure.
Level after level after level, just like we've seen all along the way here, that we've been tracking these markets that, you and I have been talking, for the last few months. You have these levels. Whoops, I lost my little marker. I'm not a technical analyst. I'm not. I use these charts to kind of plot ranges and stuff, but I was trying to find my little marker. But one of the things that I did do was mark something off that's interesting. So today's November 9th, right?
Mm-hmm.
So what I've been saying is this range here, like there's been a lot of people with charts and custom indicators and stuff saying this is the bottom. All my charts are showing it. Bitcoin does this every time. This is the bottom, best buying opportunity of your life. Well, all of those indicators, whether you're looking at moving averages, whether this is the daily moving average, 200, 150, whether you're looking at RSI, whether you're looking at MACD, they follow price. So as soon as price dumps, the indicators follow it and move. So you can have a custom indicator all day long that did the same thing, every time in history, but this is different. This is a very different time. We're in a global macroeconomic bear market. It's risk off. The Fed's tightening. They're raising interest rates. It's not the opposite. So it is a very different time than what we saw, back here in 2018, when, we had the last cycle, and, these people that are showing this and saying that this is where we are and that now we're going to get this big spring out of here and start, going back to a bull market. That makes zero sense. Sure. This was a macro bull market cycle where trillions of dollars were still being pumped in the economy. Interest rates were at artificially low levels. It's a very different environment. And I think people are starting to realize that now. And here's November 9th, 2018. So I've been saying in my last videos, I feel like we're right here. I feel like we haven't had a final capitulation. We haven't seen panic selling yet. In the markets. We might start seeing it now. We haven't seen it yet. I've been posting that on Twitter. I've made videos. And, when you put the moving averages on, what happened was when we came up and hit that 200-day moving average the last time in 2018, then it was the 100-day, and it never regained the 100-day, and that's when it went off the cliff. So when you move forward here, November 9th, 2022, here's where we are. We hit the 200-day moving average, lost it, never came back above the 100. final capitulation. So I think my thesis is we're right here. And this is the first leg of this move down. And that's a 50% drop. And I made a video, Bitcoin could drop 50%, and that's 10,000. So that's in the cards. The other thing is, in the last 4 years, Bitcoin has hit $3,500 and $4,000 twice in the last 4 years. It could go down to $3,500 to $4,000.
Sure.
Is that probable? Yes. Is it likely? No. What's likely is 14 to 15. If that doesn't hold, then 10 is your next level. And if that doesn't hold, then we know the ultimate bottom the last 2 times, and actually 3 times, because the last drop before the 2018 run up was $3,000. So I don't feel like it would go below there. It's definitely not going to go away. Miners are under pressure. They're starting to shut down rigs because they can't sell the Bitcoin for enough money right now at this price to sustain operations and pay electricity bills. So that could be a problem. If it drops low enough to where the miners today, with today's costs, can't maintain the network, then what happens? So that's a whole different, that's above my pay grade in terms of figuring out how that works. Sure. But right now, I think your biggest risks are there's some more miner capitulation. There's some more leveraged players out there, large holders that are going to have to sell, and whatever else we find below the surface. And right now we're getting closer to that 14 to 15,000 level that I've been talking about for the last few weeks. So that's where I'm at right now. I think we're going to stop there, bounce around a little bit, and then here's the other thing on that 2018. Like I said, this is November 9th, 2018 or 2022. And here is November 9th, 2018 on the Dow. November 9th, 2018 on the NASDAQ. So traditional markets are getting ready to, get a spanking too. Sure. 2018, November 8th. So, this is midterm election. This is Fed tightening. Okay. That's what happened. That's what we're dealing with now when you fast forward, to today. Midterm elections, Fed tightening. Midterm elections, Fed tightening. These are traditional markets. Midterm elections, Fed tightening. And then, Bitcoin amplifies what happens in the markets. Of course, you add FTX to the mix, but this would have happened anyways. Without FTX, we would have had this and started moving to that next leg down. They're just adding fuel to the fire, and it's happening a little bit quicker. So where does it end? Last time, it took 30 days to hit bottom before it started bouncing around here. That's when the Fed pivoted. So the Fed pivoted, and that, when I say pivoted back then, that means they dropped interest rates and kept injecting capital.
Right. So
they went back to to an quantitative easing cycle. A Fed pivot this time means they're just going to stop. They can't go back in and support. They're not going to prop up traditional markets. They're going to let traditional markets settle. They're not going to prop up crypto, but they're kind of connected. So if they do anything in the traditional markets, now they might intervene in the bond market, stuff like that. But they're not going to intervene in the stock market right now at this level. Maybe, S&P 2,900, somewhere around there, they might jump in, which is significantly lower than where the S&P is right now. We're at 3,700. So that, that's a long way off right now. I mean, that's another 3,700, 2,900 is down here. So that's a significant distance to cover. So Greg, that's kind of where we're at. And it's just really, it's all about the liquidity cycle. It's the business cycle. We've been in a parabolic bull market for the last, couple of years off the pandemic with $2 trillion pumped into the economy.
Right.
Super bubble has popped. I mean, that's just where we're at.
So, obviously what the Fed is doing, they're still putting the pressure, right? Trying to get things lower, the markets lower, jobs, all that, layoffs and all those things, right? Do you think, to your point of the 30-day window when we might see the bottom, we see the bottom by December or January?
So what I'm saying is in 2018, Bitcoin hit the final bottom 30 days after that November 9th capitulation move. That's just what happened back then. So my thesis this time is we could potentially be putting in a bottom here, over the next few weeks to 30 days,
Okay.
While we have to get through the inflation print this week. That's tomorrow. So we need to see where CPI prints tomorrow. We need to see what the Fed does in reaction to that in December. Once we know those things, then we can start to put that bottom in because the elections are done, inflation's done, the print, not peak inflation or whatever, but we'll know a little closer to where we stand. Is it peaking? Is it still going up? And then we'll know what the Fed's response is and thinking to go into Q1, Q2 next year. So really Q1, Q2 is where I think we're going to see the potential probably mid next year, Q2, going into Q3, where the Fed can back off at earliest. So I'm thinking the earliest we could start to see markets rally and start maybe putting in a nice, rally and recovery and start working its way back up would be mid to 2023, Q2 2023. As far as the markets overall bottoming, we got to get through December right now. See where we're at. If it's bad news, markets could take another leg down and then start to put that bottom in there. But again, we don't know where we stand from a recessionary standpoint. We're not going to find that out till Q1, Q2 next year because a lot of people still have savings. A lot of people are still spending money. You got the holidays. People that are getting laid off in the tech sector and white collar jobs are getting severance packages. So they've got several months worth of cushion to get through right now. The real contraction will start next year because you have taxes due, you have, costs are still high, people are burning through their savings, racking up credit, all that. Party's over then. It's the winter months. So I think that's where you're going to really see what the economy from a recession is going to look like that the market hasn't priced in yet. Markets are forward looking, but They can't look that far yet because we don't know. We got to get through the rest of what's happening this year to figure that out. But I feel like, we'll hit that bottom somewhere around the first part of next year. And then if the Fed can back off, if inflation starts to contract, it's bull market on Q2, Q3, potentially from there. And that's when I'm going to be on this show going, now's the time. Let's roll.
Right. That'll be the time you flip bullish. But right now it's just max pain, right? Till we reach that point.
The probabilistic likely reality right now is more downside in all markets. That's just where we're at. Real estate, crypto, stocks, everything. You've got more pain. You've got more contraction. Now there's some great trades to be made. I traded Facebook the other day when it dropped. I bought some Facebook. I got out today at $103 before it dropped again. I've been trading some AMC stock, and I haven't really done much with crypto because that moves too fast for me.
Sure.
I don't like it right now. Yeah. I did earlier, but the last, probably, I don't know, 3 or 4 months, I haven't done anything because it just, these down moves are just too fast.
Yeah, it's just been on a spiral downwards, and it's tricky. They're very risky to.
Yeah, I pulled all my money out of crypto. I don't know, it's probably 3 or 4 months ago, and haven't done anything there. It's just been stock markets because you're getting better moves in the stock markets. Bitcoin's been a stable coin really for the last few months.
For sure. And on the real estate front, you mentioned that some of these builders are still, finishing out the projects. And you mentioned some of the related companies to the real estate industry, title companies and so forth, are feeling it. Do you feel we're close to the bottom there, or there's still more to go as far as home valuations going down?
Yeah. Real estate takes a lot longer. So yeah, we're 6 months to a year before you're going to see any real contraction in real estate. And it depends on how long the rates stay up above, 7%. I mean, that's real damage being done to the housing market. And really the housing market, can contract 30, 40%, and then you're just back to where it was before the pandemic run up. So, I mean, we saw prices run up 30 to 40% in some markets over the last 2 years. So that's not a bad thing in terms of where we are. It's not like 2009 where you were at normal levels and it dropped 50% and it took 15 years to get back. But the one thing that I'm not sure of, and I don't know that we can get back to, is interest rates as low as we saw them. I don't know that the Fed can get back there just because of inflation. Inflation is entrenched right now, and the labor market is still super strong right now. And until those two things get back into check, you can't even think about lowering interest rates or doing anything from a quantitative easing standpoint. You have to stay restrictive, and you have to keep, these, and this is what the Fed wants, because they want you to feel less wealthy. And the conversation goes, people out there saying at home, around the dinner table, honey, our 401k has been cut in half. Our credits, kind of racked up. I lost my job. We really got to stop spending. and even if you didn't lose your job, you're retired and your retirement account's been cut in half. Look, we need to cut back. So that's what he wants. People that would normally refinance a house, take the equity out and go spend it on whatever, a vacation, a new car, all these different things, home improvements, they're going to cut back on that because you can't. So you've lost value in your house. The interest rates don't make any sense. You can't tap into that equity. So if your equity's down, your retirement's down, you've lost your job, you're not going to spend any money. So this is what they want. And that's why I've been saying all along, this is very controlled devaluation, level to level to level of asset prices. This is what you have to correct, markets. But this is what's going to create all the opportunity. What's really cool about all of this is we've been there multiple times now. So it's the old saying, man, if I only known back then what I know now, well, we're getting ready to be back then and we know now. So it's going to be really exciting opportunities. You just have to manage your risk along the way so that you have ammunition, when these times happen. And man, I'm a super optimistic, super bullish guy. It's funny, a lot of people think what I'm talking about is bearish and whatever. And I understand people are under pressure. They've lost money. I get messages all the time. People are like, man, I lost so much money. I bought back in, November, in December, and they just don't know what to do. And they're like, is it going to come back? Is it going to come back? I'm like, it could be years. So that's the other thing. I'm optimistic. I'm bullish and I'm excited when we put that bottom in and when the Fed, can stop. But unless they juice the markets, it could take a while to get back to where we were. And then the real question is, how far can it go? Because a lot of the silliness that drove the value of Bitcoin and crypto and all these assets has been wiped out of the market. The Sam Bankman-Frieds, the SPXs and the Do Kwons and the Celsius that were, doing things that you're not supposed to be doing, they're gone. So all that's, you got to get these players back in or people like them to help juice the markets to get those big returns. And, where we're at now at the levels that we're at, if Bitcoin only drops to, 10,000, well, you might get a 5X or a 6X out of it. You're not going to get a 20X out of it. It's not going to go to 200,000, without trillions of dollars being pumped into the economy by the Fed. It's just not going to, so the question is, where will it get back to? If it gets back to 50 or 60, it's going to be hard to crack because there's a lot of people that's where they're in at, and they're going to want to get out as soon as it gets back there. And, altcoins are extremely dangerous right now.
Yeah.
Months ago, I was saying altcoins could drop 95% from here, and people thought I was crazy. Well, where we're at right now, they can still drop another 95%. Let's take a look at what I'm talking about, Ethereum. So Ethereum, as we know, has, benefited from the ETH merge and all that speculation. It's kind of unwinding its move, hanging on. ETH's going to drop last, right? So after Bitcoin's done dropping, then ETH's going to the bottom's going to fall out of ETH, and we're going to go back and test this 800. I mean, just like Bitcoin, it's going to crack it. ETH could easily go to $200-300. I mean, that is what is probably that's a real probabilistic outcome for ETH right now, and it's likely that it could go. And that's just where it was over here before the big run up. Right. So to think that it can't go back to 100 or $200, I mean, that's where it's been, and that's where it was for years before it ran up. So it very well could go right back there for a while. Just like XRP, a lot of people were saying, oh, this structure here is bullish, XRP's off to the races. Same thing. This was all, trial speculation and all that. And, it's completely unwound that move. Cardano's completely unwound every speculative move it's had based on whatever they thought Cardano was going to do. And Solana, of course, the Alameda research risk there with Solana, that's kind of unwinding. But, Solana was at 80 cents, back here before it ran up, a couple dollars. Right. So to think that it can't go back to a couple bucks, I mean, that it absolutely can. I'm not saying it will, but that is a real probability when you start running statistics on these altcoins. So, this is a time to be real careful. Like, this isn't cheap. Like, a lot of people think these prices are cheap right now. This is not cheap Bitcoin. Down here, where you've seen these macro lows at 3,000, 3,500, that's cheap Bitcoin. That's where you can get a 20x, 30x out of Bitcoin. This is not cheap for Bitcoin right now.
For real quick to circle back to real estate, because I know some people have been talking about buying in this market. Any recommendations that you have? Should they wait a little bit, even though the rates are high, but the valuations may continue to go down?
That's a personal thing. So if it's an investment, you have to understand that values are going to continue to contract in some markets. So what you buy today is probably not going to be worth what it would have been, and you're going to pay exponentially more for interest rates. So you're losing double. It's increasing the velocity of your loss. And it could take years, again, depending on what happens. And from a recession, from interest rates and all that, I mean, the last time, it took, 12, 13 years for prices to come back, 15 years to break them. So you could be facing that. But, if you're in a house long term and you want a house, you need a house and you don't care and you got to live somewhere, then, that's up to you. The problem is with interest rates right now, most people don't qualify for a house, so prices have to come down a little bit. So if you're an investor for cash flow, you can pay anything. You can pay whatever you want as long as it cash flows. So from an investment standpoint, and you're renting it, you can pay anything you want to pay as long as it meets your return requirements, cash flows, covers the debt, all that. But if it's a permanent residence and you're living there, it's really a personal decision whether or not you want to take that on right now. Rates potentially will come back down at some point, but they could go up. There are some economists that say 10% interest rates are a real thing, and we might be there. And, it may be years before we ever get back to 5% rates again. I don't know. Just like I don't know where crypto is going to go or where stocks are going to go. I mean, I don't know. I just know what the probabilities look like and, what's likely and realistic in this environment right now.
Yeah, absolutely. You got to be prepared for all scenarios, right? You can't just be bearish or bullish or whatever it is. You got to look at all scenarios. Question for you, and it's more on the larger civilization, maybe the political realm. How much can the Fed, how much pain can they cause until people start protesting in the streets? You know what I mean? With all these layoffs and not being able to afford a home and so on and so forth. How long do you think?
That's not what puts people in the streets. What puts people in the streets is inflation. They can't afford to feed their family. So that's why the Fed is focused on inflation, because that's when you will see people take to the streets. If you can't afford to feed your family and buy food and your energy bills are too high and all that, for the most part, people don't care about stocks because they've been conditioned,
yeah,
it's always going to come back. It always goes up. It'll be fine. This is temporary and it's very short-lived. Real estate values, it is what it is, right? Everybody knows interest rates. Well, a lot of people don't know because a lot of people haven't been through these cycles, but those rates were not real. That was not, when you look at the history of interest rates, where we were the last 2 years, that's not a real thing.
Right.
That's a very distorted level. So that's not going to put people in the streets. Losing your job is not going to put people in the streets because, even the labor secretary said the other day, my job is to get unemployment down. And a Bloomberg analyst was, interviewing the labor secretary and said, well, Mr. Secretary, how are you going to get inflation down and labor unemployment down at the same time? He wants the unemployment rate to come down. You can't. You have to destroy jobs. And again, the jobs that are being destroyed right now are getting severance packages and, they're high level jobs and they can likely do something somewhere else. And there's still a lot of jobs out there. But what will put people in the streets is when they cannot afford to buy bread and milk and, steak and meat and stuff like that. That's already grumbling. Those grumblings are already out there.
Sure. Greg, man, always insightful information. And, your thesis certainly correct. And I can't wait for when things change and you turn bullish because,
I will. And I'm telling you, it's going to be just like this. I took a lot of heat and a lot of hits, but it's just, I've been through it. Right. I've been there. And a lot of people, this is my third cycle. A lot of people haven't been through this. A lot of the people that invested or got into crypto got in the last, 2 or 3 years.
Right.
A lot of people in the markets got in the last 2 or 3 years. A lot of your analysts out there, your fund managers, your investment managers, your Sam Bankman-Frieds, they've never seen a bear market 2009 global macroeconomic crisis. They've never been through something like that. The big thing is, I don't know what's going to happen, but I know what can happen. Right. That's the difference. So I'm not saying it will. I'm just saying I know what can happen. And things can go a lot lower for a lot longer than you ever thought possible. The old saying, markets can stay irrational longer than you can stay solvent. Things can go to levels on both ends, like we saw, that you just don't think they can get to. So what I know is cash is king. It always has been. It always will be. When those opportunities are there, you want to have the resources to take advantage of them, because that's where your exponential generational moves are. The other thing is, and you've heard me say this before, the most important thing to know is the top, not the bottom. Doesn't matter where the bottom is.
Yeah.
You need to know where the top is, and you need to take profits and get out, let it come back down, and then buy back in, double, triple, and then it goes back up. Not the exact bottom, but it's if you got out at 64 and bought back in at 30 and it goes down to 3 and comes back up, man, you're in good shape.
Right.
So you need to know that top, and you need to understand when it's time to take some profits. And the diamond hands, hodl, that doesn't always work always and forever for every asset at every point of entry.
Yeah. I remember when the price was going up last year, even in early 2021, I was like, I'm taking profits at 45K and then 50K. And people are like, you're crazy, it's going to 100. I'm like, no, I don't know that for sure. I'm taking profits.
And if it does, great. I made my profit and I'm fine. I bought and sold real estate that you can go back and look at. And if I would have held on to it all, it'd be worth 10 times what it was that I sold it for over the years. But, I still did pretty well.
Yeah. Yeah. There's no guarantees. And I think sometimes when the market's running up, you get euphoric and it's like, oh, it's going to keep going up forever. No, it's not.
Yeah. I mean, the history of the markets they have gone up over the history of time, but there's no guarantees that they will continue, because we're in a very different time right now. I mean, governments are over leveraged, individuals are over leveraged. This is a very different, this is what I'm trying to get through to people. What we're experiencing right now, you can't compare to anything else. Sure, I look back at 2018 and what's going on there for Bitcoin, because it's there and it happened or whatever. But where we are in this economy globally, we have never seen in the history of the world ever. It's not like 2009. It's not like the 70s. It's not like the 40s. The economists are kind of looking at these different times.
Sure.
This is way different. We're a globalized economy. We've got debt that we've never even thought was possible. Countries around the world with the dollar doing what it's doing are facing insolvency. They've got serious, hyperinflation. We haven't seen hyperinflation. I mean, they've got 300,000% inflation. We've got, 8%, you know what I mean? Probably more closer to 15 if you put real numbers on it, but what they're measuring is, 8%. So this is a very different thing we're experiencing. Nobody knows what could happen and what's lurking under the surface out there that could really collapse things, and nobody will be able to do anything to fix it. So that's kind of where we are, and you just have to be smart about it and just protect yourself and take profits when you can and be smart and manage risk and things like that. So it's not about being bullish, it's not about being bearish. It's about understanding the risks that we're facing, from a global economic standpoint, and that these times aren't going to last forever. Bad times never last forever. Good times never last forever. It's business cycles, peaks and valleys.
Yep. Boom and bust.
Dust will settle. We'll be okay. And there'll be some really great opportunities. And, just have your strategy. And if diamond hands are your strategy, that's great. Just understand you ain't going to live forever. Everybody liquidates. You're going to have weddings and, graduations and diapers and things that you need. So just make sure that you're smart about it and you take profits when you can to take care of your daily needs and things like that. That investment portfolio, isn't always going to be where it needs to be when you need it. I mean, if you're retiring right now and you need your money, you're in bad shape. Or not retiring, but let's just say you need money now and you had it in the market, and you're in bad shape right now because you got half of what you did before.
Yep. Greg, always great info, my friend. Thank you so much.